Hello, I'm Nicholas Hyatt, an investment manager here at Wealth Club, and I'm joined by Charlie Huggins, the manager of our quality shares portfolio. The portfolio invests in 15 high-quality companies from around the globe and is available exclusively from Wealth Club. Charlie, the quality shares portfolio has just passed its 6-month anniversary. What have the highlights been?
Overall, I think a fairly solid and steady performance from most of the companies in the portfolio over the last 6 months, with the odd exception, as there all generally is, which I'll cover later. So good revenue, profit and cash growth from most of the companies in the portfolio, set against a relatively challenged economic backdrop, so that's been encouraging. We've obviously had high levels of inflation over the last 6 months, and pretty much all the companies in the portfolio have been able to pass through price increases, so they've demonstrated a good level of pricing power. In fact, many of the companies in the portfolio have grown profit margins through the last 6 months, so that has been encouraging. And probably added to that, which is the third theme, would be acquisitions. I mentioned in my video on interest rates recently that higher interest rates were leading to more acquisition opportunities because they have increased financing costs for a number of businesses. And we've seen a number of companies in the quality shares portfolio take advantage and complete acquisitions over the last 6 months.
Any big winners in there?
Microsoft has performed well for the portfolio. They released results in July, their full year results, and they showed 14% growth in profit, operating profits at constant currency, so good level of profit growth, and general optimism around artificial intelligence, which I'll cover later, has also benefited Microsoft's share price. Beyond that, good performance from Diploma and Roper Technologies. Very different businesses. One's an industrial distributor, the other, Roper, is predominantly a software business. But one thing they do have in common is that they, in my opinion, are both very astute acquirers, and they have been two of the companies that have benefited from acquisitions which have helped to accelerate their growth over the last 6 months. And Relax has also performed well. It's benefited from recovery in its events division coming out of the pandemic, and it's also seen good growth in its legal, risk and journals divisions.
And how's the portfolio done overall?
If we look at the 6 months from the first official trading date up to the 22nd of September, of the 15 companies in the portfolio, 5 are significantly up, 7 have had modest increases or decreases, and 3 have had larger declines. So overall, in the 6 months, the portfolio has eked out a return of just over 1%, slightly lagging behind the benchmark, the IA Global sector, which returned 4%. And I should add that both are stated after management fees.
And what's behind that stronger benchmark performance?
I think the main reason is the very strong performance of US tech shares over the last 6 months. So the 7 largest constituents of the MSCI World Index are all US technology companies and all have performed very well. So gains have ranged from about 11% for Apple to around 30% for Amazon and Tesla, 50% for Facebook owner Meta, and an exceptional 57% gain for NVIDIA, the chip giant. The quality shares portfolio only holds one of these big tech companies, which is Microsoft, whereas the average global fund is likely to have much greater exposure.
And what do you think is driving that really strong performance in US tech?
I think there are probably 2 main reasons for the very strong performance. The first is simply a recovery from last year. So in 2022, we saw US tech shares fall a long way. People were worried about the economy, they were worried about interest rates going up, they were worried about a more difficult environment for technology companies. And so far this year, we've seen a big recovery. So sentiment probably became too depressed last year. This year, people have reappraised. The economy maybe hasn't fared as bad as people thought. And tech shares have enjoyed a very strong bounce back. The majority of those big US tech names are seen as AI beneficiaries or winners. No more so, of course, than NVIDIA, which is a chip company. And since ChatGPT launched, we've seen a lot of companies scramble to launch AI solutions. That has driven up demand for NVIDIA's chips, and NVIDIA has seen very strong revenue growth as a result.
You don't own NVIDIA in the quality shares portfolio. Why is that?
I don't own NVIDIA. There are a couple of reasons. First of all, NVIDIA is quite a complex business. It's operating at the cutting edge of technology, and I just tend to steer away from the complex and the esoteric. I like simple businesses. NVIDIA, because of operating at the cutting edge of technology, is quite complicated to understand. The other thing with NVIDIA and artificial intelligence, the markets it operates in, these are very fast changing, and AI is a relatively new technology. It's changing quickly. It's difficult for me to know how the competitive landscape and how the technology itself will evolve over the next 5 to 10 years. And therefore, it's difficult for me to appraise what NVIDIA's business will look like in 5 or 10 years. So combine that with a valuation that doesn't leave a lot of room for disappointment, and I'm happy to steer clear of NVIDIA for now.
What about the other big US tech names? So the Teslas, Alphabets, Amazons. Are they ever likely to make it into the quality share portfolio?
Well, I mean, I'd never rule it out, clearly, but and I do monitor them, but I think it's unlikely that they'll be making an appearance anytime soon. Most of those US tech shares don't actually fit in my process very well. One reason for that is that they're operating in quite fast-changing industries. So you look at Tesla, electric vehicles. Yes, demand for electric vehicles is likely to grow over the next 10, 20 years, but how will the market evolve? How will the technology evolve? How will the competitive environment evolve is difficult for me to say. What I can see at the moment is it looks like competition is going to be quite high and is only going to intensify over the next 10 years. So that makes it difficult for me to assess whether all or most of the spoils will go to Tesla. Beyond that, something like a Meta and Alphabet, they are no longer capital light in the same way that they were a few years ago. In other words, Meta is spending heavily on the metaverse. Alphabet is spending heavily on things like autonomous vehicles. Again, difficult for me to appraise. I dislike companies that have to spend or choose to spend lots of money. I prefer capital light businesses. Apple, very dependent on the iPhone still. How will anything come along to supersede the iPhone in the next 5, 10, 15 years? It's possible because consumer technology does tend to change quickly. So I don't have a negative view on these companies by any means, but I am maybe a bit more skeptical than some. I also think the regulatory risk is quite high for a lot of these names still, and that's something that we were hearing a lot about a few years ago, but less so now. But I don't think those risks have gone away.
So going back to the portfolio itself, Croda has been the biggest detractor from performance. Is that just a blip or something we should be more concerned about?
So Croda has seen an issue that a number of other companies have experienced in the last 6 to 12 months, and that is destocking or inventory normalization, whatever you want to call it. The supply chain pressures during the pandemic led to many companies increasing inventories and stocking up on components. And as those supply chains have started to normalize, a lot of companies are choosing to run down their existing inventories. So even if end market demand is holding up relatively well, that has led to pressure on the revenues for a number of businesses, and Croda is one of those businesses. So it's seen destocking in its agriculture sector and in personal care, and that led to a profit warning in June. So that means that revenue and profit for this year will be lower than expected and will be down on the prior year because of this destocking issue.
That kind of suggests that there's been a build-up of inventory in the past, and maybe sales weren't quite as high, really, as they seemed at the time. Are you still comfortable that Croda is as high quality as you thought it was?
Yes, so you're right. I mean, I think Croda did go through a period where its revenues were perhaps elevated because of this stocking up of inventories, and now we're seeing that unwind. Um, and that has certainly had a short-term impact on the performance of the business and the share price. Having said that, Croda's customers can't go on reducing inventories forever because they'll run out of things to sell. They will need to replenish their inventories at some point. So while it is difficult to predict demand for the business in the very short term, looking medium to long term, once this destocking issue is passed, then demand should really be driven by underlying end market demand. And for Croda, that should be driven by innovation. So companies coming out with new skin creams, maybe with more sustainable ingredients, something like that, that would play right into Croda's sweet spot. And looking to the longer term, what excites me most about Croda is demand in its healthcare business. So Croda supplies chemicals into drug delivery systems, and these go into vaccines, for example. And over the next few years, what we're likely to see is a number of new innovative vaccines launch, which use Croda's chemicals. One example being cancer vaccines. So I'm hopeful that as these therapies launch, Croda will see a good demand boost, but that we're having to be a bit patient because most likely this isn't going to be for a couple of years yet.
We're 6 months in. Have you made any changes to the quality shares portfolio at all?
I haven't made any changes so far. So the 15 names in the portfolio today are the same as they were at launch. I clearly am looking for new ideas. I continue to build up my watch list, and I have some good names on that watch list, but I haven't felt the need to make any changes. I'm broadly happy with all the companies that I own, and that is reflected in the lack of trading activity.
And we've talked about some winners and some names that have perhaps struggled a bit over the first 6 months. Have you done anything to rebalance out that performance?
No, I haven't. So I did say when I launched the portfolio that I would look to rebalance periodically, but I haven't felt the need to rebalance the portfolio yet. So yes, we've seen some diverging performances from some names, but overall the weightings of each of the names I'm quite comfortable with. So I will potentially rebalance for risk management reasons if any one position comes to dominate, but that hasn't happened so far. And as a general rule, what you'll find with me is that unless I have a compelling reason to trade, I tend not to, because the only thing you guarantee is increase your costs if you trade without a compelling reason.
I think that lack of trading activity is something that really sets the quality shares portfolio apart from what you get with a lot of fund managers. Mm-hmm. Is there anything else you think that is particularly distinctive about the offer?
Well, I think there are two main ways that the quality shares portfolio differs from the mainstream. It does offer some different exposure to different sorts of businesses. So you will find, obviously with a tracker fund, you're heavily exposed to those US tech names. So there's nothing wrong with that. I think they're very good businesses. But you often tend to find with active managers as well that they will crowd into those names because they're big benchmark positions. In this portfolio, aside from Microsoft, you don't get exposure to those, at least not at the moment. So it could serve as a portfolio diversifier, I think. Added to that, my investment approach is very long-term, is very patient. It is very much predicated on that 5 to 10 year business performance. I don't think many fund managers, there are a few, but I don't think there are many that run money that way. I think that the second key difference is the level of information and insight that's provided. So with most funds, you'll get a top 10 holdings with a fact sheet with, if you're lucky, some very limited commentary on the portfolio. The quality shares portfolio aims to go much further than that. So if you invest, you'll see every single name in the portfolio, why I own it. You'll get a detailed investment update on the portfolio every month. So I think it will appeal to investors who are highly engaged, who want to learn more about companies and markets and want to know the reasons behind a manager's decisions. So that is what the quality shares portfolio aims to achieve.
So how do you feel about the performance of the portfolio in its first 6 months? And what do you think the future could hold?
Well, I think you have to separate the share price performance to some extent from the business performance. So in the short term, those two can diverge. Sometimes they can diverge quite widely. So what we've seen in the first 6 months is a relatively lackluster share price performance. But in terms of the businesses themselves, I am broadly encouraged with the level of growth, revenue, profit, cash growth from the portfolio that's been seen despite a not terribly conducive economic backdrop. The valuations in the portfolio generally, I would say, are reasonable. The progression from the businesses, the profit progression, I believe has outstripped the share price performance so far. So in other words, I think the portfolio has become a bit cheaper over the last 6 months, and hopefully that bodes well for the future. You never know what's going to happen with the economy. Things remain uncertain, but I've tried to choose businesses that I think will be resilient to that and can emerge stronger. So we'll have to see how the economic environment plays out, but I'm not unduly concerned by that either.
And finally, for those who aren't yet investors in the quality shares portfolio, or maybe who are and want to find out more, where should they go?
Well, there's lots of information online, and we've actually added more information as time has gone on online. So I would encourage you to go there and also check out my blogs. I've written around 20 blogs now, and if you read through some of those, you'll very quickly get to see my investment approach and how I think about this portfolio. So that's probably a good starting point.
Fantastic. Thank you very much, Charlie.
Thank you very much.